In problem 3-9, we're going to do two things. First, we're going to prepare journal entries for the year, and then second, we're going to post our journal entries to T accounts. But I think what I'll do is I'll do those two steps together, where I'll do the journal entry, and for where I've opened up T accounts for these ones, I'll post into them at the same time. And then once we're doing that, we'll look at putting together a income statement and then also clearing out your manufacturing overhead account because we need it to be zero at the end of the period. Okay, so Almeda Products uses a job order costing system, and the company's inventory balances on April 1st, the start of its fiscal year, were as follows. So I need to put these amounts into my inventory accounts. So raw materials was $52,000, so I'll put that in here. So that's the beginning inventory account. Work in process was $40,000, so I'll put that in here. And then finished goods was $38,000. So these were all of the ending amounts in the previous month, so at the end of March 31st. Okay, so during the year, the following transactions were completed. A, raw materials were purchased on account for $170,000. So the journal entry will be to debit raw materials for $170,000. And then I'm just going to credit accounts payable. Because it said it was purchased on account, then that makes me assume that we didn't pay cash for it. And just maybe to help you with your inventory accounts, when you think of debit, think of something going into the inventory account. And then when you think of credit, think of something going out of the inventory account. So raw materials is 170, that's coming in, so that's a purchase. And then eventually we'll have something coming out of the account. So right now I've got my beginning materials plus what I purchased this year. This is how much I have available to use. So that's just these two numbers added together. So B says raw materials were issued from the storeroom for use in production. 200,000 indirect labor, 80% direct and 20% indirect. So I'm going to record work in process, and that's for my direct labor. Oh my gosh, I keep reading C. That's for my direct materials. I'm also going to record manufacturing overhead, and that will be for your indirect materials. And then we will put this, we'll take it out of our raw materials account. So it'll be out. So I've got 200,000 coming out, and the direct materials was 80% of that, so I'll just take 200,000 times 80%. And then the manufacturing overhead was 200,000 times 20%. There we go. So I'll put the work in process, the 160,000 in. That's going into the work in process. The manufacturing overhead in is the 40,000. And then the raw materials out is the 200,000. So that's what we used. So now what you can see in the raw materials account is we had 222,000 available. We used 200, So our ending raw materials account is $22,000. Now, if I look at the work in process account, this beginning is made up of direct materials, direct labor, and applied manufacturing overhead from jobs that were started but weren't completed in the previous period. So then we're just adding on to them for this year. In Part C, employee salaries and wages were accrued as follows. Direct labor, $200,000. Indirect labor, $82,000, and selling and administrative salaries, $120,000. So I'll go ahead and put this together. So my name of my accounts will be work in process. That's going to be for my direct labor. So that's in. Manufacturing overhead. That's going to be for my indirect labor, in. Then I'm going to put down salaries expense. And this is just for my period costs. So if the labor didn't have anything to do with manufacturing the product, but had to do with selling the product and also administrative expenses, then it's going to be salaries expense directly onto the income statement. And then I'll just go salaries and wages payable. So let's get those numbers again. 282, 120, and what I'll do is I'll just add those up together to come up to 402,000. So now I can put the direct labor in to work in process. And then I can put indirect labor into manufacturing overhead. And I don't have a T account open for salaries expense, so I won't post anything there. Now I have utility costs were incurred in the factory for $75,000. So it tells me factory. So what I'm going to do is I'm going to put that as manufacturing overhead because that's an indirect manufacturing cost. If it didn't say it was for the factory, then I would put it just as a utility expense directly on the income statement. So that's $75,000. Now I'm just going to assume accounts payable. You could also put cash. It doesn't say how that was paid, or if it was even paid yet. In Part E, it says advertising costs were incurred for $90,000. So advertising is just a part of the selling costs. So I'm just going to put it as advertising expense. So this doesn't have anything to do with the manufacturing process. And again, I'll just guess it's accounts payable. You could also put cash. It doesn't say. And I forgot to post this one, the $75,000. So let's go ahead and put that. I believe that was the utilities. Let's put that into the manufacturing overhead account. So that goes into that account. So just remember, in and out, debit and credit, debit in, credit out. Now, F says that prepaid insurance expired during the year. 20,000, 70% related to factory and 30% related to selling and admin activities. So what you have to remember about prepaid insurance is that it's already been paid. So it was probably paid either at the beginning of the year or somewhere in the middle of the year. And then what we do is we move it onto the income statement, or we move it into the manufacturing overhead when we use it up. So that's what it's talking about. So let's see here. 20,000. And manufacturing overhead is for the indirect portion. So that's 70% related to factory. So I'll just take 20,000 and times that by 70%. And then I will do insurance expense. For the difference. So what you could do is you can take 20,000 minus 14 to get the 6,000, or what you can do is just take the 20,000 and multiply it by 30%, and that should give you the same number. So let's just prove that. 20,000 times 30%. So that gives me 6,000. And I don't have a T account open for insurance or prepaid insurance, but I do have one for manufacturing overhead, so that's insurance in. So I'll do the 14,000. Now in Part G, it says depreciation was recorded. So at the end of the year, what we normally do, or it could be at the end of the month or quarter, we'll record depreciation. So it's just a way to decrease the cost of our asset in a systematic manner. And so we call that depreciation expense. But since some of this is related to the factory, then what we're going to do is put the depreciation for the factory in as manufacturing overhead. So I'll say that, manufacturing overhead. And then the depreciation for the stores, depreciation expense, we'll call that depreciation expense. And then we'll call this accumulated depreciation. And that's a contra asset account that goes on your balance sheet as an asset to the cost, and then it just decreases that cost. Okay, so the total was 150. And I think this one was split 80-20. So 150 times 80% gives me 120. And then 150 times 20% gives me 30,000. And I don't have T accounts open for those ones, so I'm going to post my manufacturing overhead. So depreciation in is the 120. So you'll just notice what I've been doing is anything that I have debit is going on the left-hand side, and anything I have credit is going on the right-hand side. Now these look like T accounts because they look like little T's. And you can also see it in the journal entries. This is a T, just kind of across and down. So that's how you can remember too. Debit left, credit right. In H it says manufacturing overhead was applied to jobs at the rate of 160% direct labor cost. So what I need to do is actually take out an amount out of the manufacturing overhead account and then put it into the work in process account, because the work in process is made up of my direct materials, direct labor, and applied overhead. So it's always those three costs make up the cost of your job. Now the problem is that I don't know what my actual manufacturing overhead will be until the end of the year. So we just kind of have to guess while we're working through the year. And we'll get a little bit more into that in a different question, but for now I'm just going to do work in process. That's going to go in, and then manufacturing overhead, that's going to go out. And I'm just going to read what it says, 160% direct labor cost. So I'm just looking. This one looks like my direct labor cost, that 200,000. I just highlighted it there. I can also go into my work in process account, and there it is. It's the 200. So they're saying we're going to allocate 200,000 times 160%. So we're just going to pretend that manufacturing overhead is 320,000. So I just took the 200,000 and I multiplied that by the 160. So in a perfect world, it would be the actual manufacturing overhead, but again, the problem is I don't know the actual overhead until the end of the year. So when I'm working on each job throughout the year, I'm just guessing. Okay, so now I can post this work in process. So that's my applied overhead into the work in process account, and then the manufacturing overhead is out. So it comes out of the manufacturing overhead account and then into the work in process account. Now I says that goods that cost $700,000 to manufacture according to their job cost sheets were transferred to the finished goods. So that makes sense. When we're done making the product and we're ready to sell it, then we take it out of work in process, because that means stuff that's not finished being made, and put it into finished goods. That's stuff that's made and ready to sell. So the journal entry that I'm going to do for that is in finished goods and out work in process. 700,000. And this number is called cost of goods manufactured. So out and in. So whatever you do to the one side, you have to balance it out on the other side. So that's why I'm kind of talking about this like in and out. Now in J, it says that sales for the year totaled 1 million and were all on account. The total cost to manufacture these goods according to their job cost sheets was 720,000. So the first thing we'll do is we'll record the sale. Because it said it's on account, I'm just going to put it into accounts receivable. And then sales is always a credit onto the income statement. And accounts receivable is just our customers owe us money, and when they pay us, then we'll put it into cash. And now the 720,000 is into cost of goods sold, and this is the number that shows up on the income statement, and then out of finished goods. So that makes sense, because when we're done making it, it sits in finished goods until we sell it. And then once we sell it, that's when we recognize it into the income statement. So I'll post the cost of goods sold of 720, and then the finished goods at 720. So if we take a look at this, let's just look at all of the T accounts. So with raw materials, we end up having 22,000 left over in inventory. So if I actually went to the warehouse and asked to see where all the materials are stored, so this is the materials before you start working on anything, I should be able to count that, and there should be $22,000 worth of materials there. Same thing with work in process. So we have ending work in process of $20,000. So these are the incomplete jobs. So if I assumed that if I'm going to a warehouse and they have all of the incomplete jobs in a separate room, then I should be able to go in that room and see which jobs are started and how much of it has been made or how close it is to being completed. So those jobs stay in that account until they're finished. Now I'm looking at the finished goods account, and those should be all of the completed jobs. So again, if I was to go to warehouse and we had all of our completed jobs in a different room, I would see all of these finished products, and they should add up to 18,000. And then when I look at cost of goods sold, these are the jobs that we finished, and now those are with our customers. So those are completed jobs. Okay, now I have a little problem with manufacturing overhead. So if we keep reading down here, it says manufacturing overhead underapplied or overapplied for the year is manufacturing overhead. Prepare the journal entry to close out the balance. So what we need to do is, this balance is sitting at 11,000 right now. I need to clear this out into cost of goods sold because I want it to be 0. So if I do 11,000 on this side, then that will make that balance 0. So let's just do the journal entry first, and then I'll explain why it's underapplied. So cost of goods sold and manufacturing overhead. That's the 11,000. And let me just post this one into cost of goods sold. Okay, so this journal entry could go either way. If it's over applied, then you would have manufacturing overhead on the top and cost of goods sold on the bottom. So here is how I knew. If I add up everything on the left-hand side, so I just added those, and you can see down here it says sum 331. And I compare that to what I allocated. So remember, I took out 320 and I put it into work in process. That means there was more actual costs than what I allocated to the jobs. So we didn't allocate enough. So that's why it's underapplied. And we have to do that journal entry. Okay, so I think all of that is done. Now the last step is for us just to prepare the income statement. So that's what we'll do down here, and then we'll be finished. Okay, so I didn't create T accounts for anything that's on the income statement. So what I'll do is I'll go into my journal entries and I'll just highlight it when I grab it. So I'm going to start out with my sales, and that's 100,000. So that's the amount that I credited in J. And maybe we'll just color them in blue. And then I subtract my cost of goods sold. And this is I'm going to take it right from here. So it's the 731. So it was the cost of goods sold and then also my underapplied overhead. And then if I take 100,000 and I subtract that from 731,000, that gives me 269,000, and this is called gross margin. So all of those manufacturing costs are stuck either in cost of goods sold or they're trapped on the balance sheet in the inventory accounts, raw materials, work in process, finished goods, depending on what stage of completion they're at. Now what I can do is list all of my selling and administrative expenses. So I'll say selling and administrative expenses. So the first one is from up here. So that's salaries expense. Now you can do 2 columns or you can do 1. It doesn't matter. But I'm just going to sum all of the expenses just in this column. And then I have advertising expense. And that's coming from this journal entry here, the 90,000. Put a little blue on there. Then I've got insurance expense. and that's the 6,000. So remember, these are period costs. So they're either product costs if they're part of cost of goods sold, or they're period costs if they don't have anything to do with the manufacturing process. And then I have depreciation expense. For 30,000. Now there could be more expenses, but we just didn't do the journal entries for them. So now if I add all of those up, then my total selling and administrative costs would be 246,000. So all I did is I added those together. And now what I can do, I'm going to call this net income, but you could also call it earnings after tax, or you can call it operating profit. I'm going to take the 269, and then I'm going to subtract my 246, and then that gives me 23,000. So that's my net income. So that is basically the profit that you have left in the company after you make the product, and then after you pay for all of your other expenses at the store level. And just to make this look pretty, we just want to have dollar signs at the beginning and end of the statement and at the beginning of each column. All right, so that is job costing from beginning to end.